What if I told you that the majority of professional fund managers, people paid hundreds of thousands of pounds a year to pick stocks, consistently fail to beat a simple automated investment that costs less than the price of a Netflix subscription per year? That investment is an index fund. And in this video, I am going to explain exactly what it is, why it works, and how you can start investing in one this week with as little as £25 a month. No financial knowledge required. This is the one video about investing I wish I had seen at the start. Stay with me. Most people think investing is complicated, and the financial industry has spent decades making sure it feels that way. Walk into a bank and ask about investing, and they will show you a brochure with 40 different funds, risk ratings, sector allocations, and a fee structure that takes a qualified accountant to understand. Most people look at that brochure, feel completely lost, and leave having done nothing. The bank is fine with that because the money sitting in your current account costs them nothing. The other thing that puts people off is the idea that investing is gambling, that you could lose everything, that you have to watch screens all day and make decisions based on news you don't understand. Here is the truth. Investing in a broad global index fund is not gambling. Gambling is a zero-sum game. Someone wins what someone else loses. Investing in the global stock market is owning a tiny piece of thousands of businesses around the world. When those businesses grow, and over the long term they do, your investment grows with them. The global stock market has returned an average of around 9% per year in nominal terms over the past 25 years. That includes the 2008 financial crisis, the 2020 pandemic crash, and every other shock in between. It went down sharply during those events, and then it recovered, and then it grew further. And the people who lost money were the ones who panicked and sold, the ones who did nothing, who just left their money in, recovered, and continued to grow. That is the single most important thing to understand about investing before we go any further. So, what is an index fund? An index is simply a list. The FTSE 100 is a list of the 100 largest companies on the London Stock Exchange. The S&P 500 is a list of the 500 largest companies in America. The MSCI World is a list of around 1,400 large and mid-sized companies across 23 developed countries. An index fund is a fund that automatically buys every company on that list in proportion to its size. No human is deciding which stocks to pick. No analyst is making predictions. The fund just tracks the index, buying and selling automatically as companies enter or leave the list. Because there are no fund managers making active decisions, the costs are tiny. The most popular global index fund for UK investors, the Vanguard FTSE All-World ETF, charges 0.22% per year. That is 22 pence on every £100 invested per year. Compare that to a typical actively managed fund charging 1.5% or more. That is £1.50 on every £100 every year. That difference sounds small, but over 30 years on a growing portfolio, it is the difference between retiring comfortably and retiring with significantly less than you expected. Now, when people hear global index fund, they often ask the same question: does that mean I am investing in companies I disagree with? The honest answer is yes, to a small extent. A global tracker will include some oil companies, some defense contractors, some businesses you might prefer not to support. If that matters to you, there are ESG, environmental, social and governance, versions of most global trackers that screen out certain sectors. They cost slightly more, but are widely available on all the main platforms. For most people starting out, the standard global tracker is the right place to begin. So which fund and which platform? Let me keep this simple. For a complete beginner in 2026, there are 3 funds worth knowing about. The Vanguard FTSE All-World ETF, ticker VWRP, charges 0.22% per year and holds around 3,900 companies across both developed and emerging markets. It is the most popular global tracker in the UK for good reason: straightforward, well established and genuinely diversified. The HSBC FTSE All-World Index Fund charges just 0.13% per year. Cheaper than Vanguard, tracks a very similar index available on most platforms, a solid alternative if cost is your priority. The Invesco MSCI World ETF charges 0.05% per year, the cheapest global tracker currently available in the UK. It tracks developed markets only, no emerging markets, but for most investors starting out, that distinction barely matters. Any of these three will do the job. Do not spend weeks agonizing over which one. The difference between them over 20 years is far smaller than the difference between investing and not investing. Now, platforms. Where do you actually buy these funds? InvestEngine, zero platform fee, ETFs only, minimum investment of £1, the lowest cost option available for a UK investor right now. Ideal for beginners who want maximum simplicity and minimum cost. Vanguard, 0.15% platform fee capped at £375 per year. Clean interface, limited to Vanguard's own funds and ETFs, which is actually a feature, not a bug. Fewer choices means less temptation to tinker. Freetrade, zero platform fee, free stocks and shares. ISA, access to thousands of ETFs and individual shares. Good option if you want more flexibility as you grow in confidence. All three support regular monthly investment plans. You set up a direct debit, choose your fund, and the money goes in automatically every month. You do not have to log in and manually buy. The automation is the point. Insight 1. Pound cost averaging is your best friend, and most people have never heard of it. When you invest the same amount every single month, say £100, something quietly powerful happens. In months when the market is up, your £100 buys fewer units. In months when the market is down, your £100 buys more units. Over time, this averages out your purchase price and protects you from the single biggest mistake investors make, putting all your money in at the top of the market. This is why investing monthly is better than trying to time a lump sum. You do not need to predict when the market is going to rise or fall. You just need to keep going regardless of what the headlines say. What? Insight 2. The single biggest advantage you have as an ordinary investor is time, and you cannot buy it back. £100 per month invested in a global index fund returning a conservative 7% per year grows to approximately, after 10 years, around £17,000. After 20 years, around £52,000. After 30 years, around £121,000. Total invested over 30 years, £36,000. Total returned, £121,000. The extra £85,000 came from compounding, growth on top of growth on top of growth. That process needs time to work. Starting later does not mean you have missed the boat, but starting now is always better than starting later. Insight 3. The enemy of good investing is not bad markets, it is your own behaviour. Studies consistently show that the average investor significantly underperforms the very funds they invest in. The reason is simple. When markets fall, and they will fall sometimes sharply, the temptation to sell is overwhelming. Every headline tells you it is going to get worse. Your account balance drops and your instinct screams get out. The investors who sold during the 2020 pandemic crash and waited to reinvest missed one of the fastest recoveries in stock market's history. The ones who did nothing, who simply held their index fund and kept their direct debit running, came out significantly ahead. The best investment strategy is the one you can stick to through a crash. A boring global index fund held automatically every month for decades is, for most people, exactly that strategy. Here is your one job this week. Open an account on InvestEngine or Vanguard. It takes about 10 minutes. You need your name, address, national insurance number, and a UK bank account. Select the Vanguard FTSE All-World ETF or the HSBC FTSE All-World Index Fund. Set up a monthly direct debit for whatever you can afford, £25, £50, £100. It does not matter how much. What matters is starting. Then do the hardest thing of all, leave it alone so it can do its magic. If this was useful, subscribe. There is a new video every Friday, no jargon, no products to sell you, just the frameworks that work. And drop a comment below. Are you already investing in index funds, or is this the video that convinced you to start? Would love to hear from you. Now you know what index funds are and how to start. But there is a mistake that millions of UK employees are making right now that is quietly costing them tens of thousands of pounds in retirement. Their workplace pension is sitting in a default fund designed to be acceptable to everyone, which means it is optimal for nobody. Next Friday, I am going to show you exactly what your workplace pension is invested in, why it probably is not working hard enough, and how to fix it in about 10 minutes. That one goes live this Friday. I will see you there.